Good Fed Day, Warriors. Let's get ready. Hi, Ingmar. How are you? AJ, Michael, Bran, Ryan, Andrew, Kman, Patrick, Blake, the whole team, James Groom, Marcus. Okay, so not a lot of action currency-wise so far. All the actions in the tech stocks. So they need the Fed. I've been talking about Apple failing to make a new high. So it's come off pretty good. And now we have AMD coming in 9 lower, NVIDIA coming in 10 lower, Amazon coming in 2.5 lower, and Microsoft, which kicked it in, actually recovered the most. It's only down $1.50. So why don't I start with Ryan? Was yesterday's action enough to get you to take profits on S&Ps? Ryan?
Hello.
Maybe Ryan's not here.
No, I'm here. You got me?
Oh, okay.
Yeah, you're coming in a little choppy there, Ryan. Your mic.
Yeah, I had a bit of a mic problem yesterday. Might still be filtering through. Is it right now?
Yeah, you're crackling. So anyway, the question was yesterday's action enough in NASDAQ to have you get out of your S&P, or you're still hanging tough through the Fed?
Yeah, I took some more off because when we made that high and we didn't break the high, I thought, yeah, let's take a bit more off. I'm looking to get my stops up a bit more now, but we're holding the support, give or take, around that 4900 level, 4905, which is important because that was the break-up point. And I'm expecting a bit of choppiness with the Fed coming up. You know, all the short-termers probably clearing themselves out, clearing the decks. Yeah, so it may move around a bit, but I won't be worried. 48.60 is the next main area I'm looking at. Should
Right
we get a few moves in it? Yeah, just that, again, that stall point, and then we had the break, and then we've had the test and the hold. So, yeah, I'm still happy to stay long, ride it.
Yeah. I mean, you know, the 2 hour short term diverge. I mean, it looks like it has to hold here. If it does, we could get another shot up. I think the Fed has to deliver a dovish message. How about that? You think they need to?
Yeah, I think they do. But if they don't, it'll be important to see how S&P reacts. Do we break all the way back down, or do we just maybe fall back to that 48.60, hold it, and then the buyers will just come running in again? So it's going to be interesting. But there's also been a bit of divergence. You know, the Nasdaq got caned, S&P got off the top, Dow still sitting at the highs.
Yeah, I noticed that. So reminds me of the expression that when the troops retreat, the generals get slaughtered. So here are the generals. And some of the troops are retreating. Maybe that intel thing meant something.
And Dale, I just want to point out, there's a lot of stocks are down today, following earnings. I mean, we have Google's down 5%. In our chat room, Gav was pointing out that AMD was down 5%. Then you got Microsoft down a percentage point. So,
were you listening to the opening of the show?
No.
Oh, okay, because anyway,
I had to go grab coffee.
You're like an echo. Anyway, thanks for the replay, but go ahead.
Maybe everybody else was getting coffee too. I had to go grab coffee.
Yeah, all right. Okay, go ahead. I thought I was hearing myself talk again.
I was gonna say this is a really good comment. SMCI, which is the AI play that was up like 10% yesterday, gave back all the gains. And, on top of that, when you got AMD down, AMD is a big AI play, chip play, So yeah, it's weighing on the market. Anyway,
AI is the new .com, buddy.
It is absolutely
the new .com.
And you know what the market's picking up on now. We've been talking about it for months. All these job cuts that are dropping.
Ryan, please fix your microphone. Ryan, please fix your microphone. Otherwise, please don't use it. I mean, people will just tune off.
He's having, it's not his bike. He's having Rice Krispies. Snap, crackle, pop. All right. Haven't you ever eaten those, Steve? Anyway, all right, let's move on to, you know, we got a tough producer here. It's a tough house.
You don't hear Steve for like months, and then all of a sudden he jumps on.
Yeah, it's like the Wizard of Oz, you know, it pops
Not
out
even
from
hello, not even good morning, not even, you know.
How you doing, Kman?
Hey, good morning. I'm fine.
Give me a hidey-ho.
How do you do that?
Just, you know, say it.
How's my sound now?
Oh, much better, Ryan. I'll shut up.
Yeah.
I'm blaming Steve because it worked fine on the Flow show, so he must have broken something.
You know, sometimes producers make audio errors. Anyway, good to have you back, loud and clear, Ryan. So, Kay, how are you approaching today?
It's a bit of a day in pieces. We are going to have the ADP, not too far a distance, but then FOMC tonight. In the meantime, we are trading month-end stuff, you know.
Okay.
This morning, again, perfect overlay of what happened yesterday with the euro crosses being beat, especially in the morning. Probably a bit more to come around for the 4 p.m. London fix, and then we will start to have a closer look at the FOMC, which I think
call on that Canada yesterday. You were looking for it to pop off 34.
Yeah, it's holding, and EURCAD is holding figure 10 as well. So those are decent levels, but I think it may just be month end. That's just my 2 cents on that. Not the dollar CAD, I don't know, but the EURCAD perhaps, and always bouncing on the same level, correct? But I don't know. We'll see whether it holds after the fixings today. No, and the FOMC to me should be a soft meeting, but there's a lot of people who are starting to think that they might say something, change the wording again, going even more neutral or showing a bit of dovishness, talk about the RRP, perhaps talk about layoffs and things. But my base case is it's a very, very soft meaning, not bullish nor hawkish, nor not hawkish nor dovish meeting today. My base is a very
important level. Pretty important level the 10 years at right here. So if it holds 4%, right, and this move was 40, and we get equality, that could take you up to 50% retracement at 440.
I don't know.
If we take out 4, close back under 4, we're probably headed to new lows in 330 in the 10 years this spring. So I thought there might be one jiggle first because it could still go to 330 even if it goes to 440, because the first breakdown was you know, 1.2, so 120 bips. So 120 bips would get you to, if it rallied then failed, back to 330. That was an important area before the market, you know, 330.
We also will have the breakdown of what the Treasury will do. I think it is slated for in about 20 minutes as well, right at the end of the F.A.C.E show.
Yeah.
Let's see if they going to do more bills than bonds again, or rebalance it. You know,
Widowmaker turning.
Sorry.
The Widowmaker.
You know, Widowmaker.
The Widowmaker.
This one. Okay.
You know what? There are so many women, widows out there right now. You know, I went to the grocery store, but you know what? After this nat gas decline, there is no one long, and with all the widows out there, I'm hiding out.
Wasn't that supposed to bounce on the back of Biden's threat to delay or abolish those LNG projects?
No, I think it'll because it's still winter.
Mm.
Okay, there still could be a weather market between now and March. It wouldn't take much to light it up. I mean, this divergence is pretty glaring. And then the other outside market I just want to cover that I've been wrong about for a long time, but I just kept looking for something to happen in the grains, and here's the beans. All right, so longer term, I think they bottomed, and if they have, if we're going, I know it's premature, but I was gray prematurely. Corn and wheat actually is putting in a higher low. So if there's going to be a big burst in inflation, we've had relatively cheap grains for a long time since they peaked on the Russian invasion of Ukraine. But if we have another wave in the grains, and I think it's going to be weather, we're going into planting season. This will put a lot of upward pressure in the next burst of inflation if what was cheap no longer becomes cheap. So I like the grains. Grains and natural gas here. So, just a few commodity plays out there. Right? I mean,
Yeah, but
I'm a commodity guy.
Then there's my question. If food is the reason why inflation shoots higher, is the Fed going to react faster or slower to that? I would say slower, but
Yeah,
because that's a very bad inflation, right?
He's not Volcker.
Hmm?
He's not Volcker.
He is not. No, he's not.
No, I mean, he was Arthur Burns in December. The guy is bipolar, but a lot of people are saying it's political. I don't know. They say all the Fed guys are Democrats, so they're going to keep the spigots going election year. Do you believe that? Do people overseas say the same things Americans do about our Fed?
Oh,
Yeah,
well, if you look at the UK, good luck finding a good central banker.
because I don't know. I mean, I've heard from a guy in Turkey. He thinks we have a great central bank. Okay.
You're coming over a bit soft, Dale. I can.
Wow. Okay.
Yeah, better.
Well,
oh, that's much better.
Okay. Yeah. So anyway, do people look at the Fed as being political here in the U.S.?
But there's a bit of a low bar asking someone from Turkey commenting on central banks.
I guess that's a good point. I asked him.
Because Lagarde is now doing politics as well. She was talking about if Trump gets reelected, what's going to happen. So,
what does she think is going to happen? What does she think is? What did she say?
That Europe is going to have a tough time because tariffs are going to come back.
They're on their own. Yeah. Okay. Anyway,
just over a minute to ADP, by the way.
Oh
yeah,
my
we
gosh.
have ADP
sorry. Go ahead,
up.
Blake.
Yeah. Yeah, I'll take over from here. Yeah, tariffs is going to be, there's going to be a lot of talking points going into this political season. That's for sure. Let's go ahead and pull up ADP. Here's our data flash. I'm gonna move that out of the way and just pull up the dollar. I'm not dealing with the dollar yen. I think the yen's been a really, really tough trade. I'm hoping it actually makes one more push towards 150. We can talk about that here in a second. But let's pull up the dollar index ahead of ADP. We've got just a few seconds here. And market's looking for about 140,000 jobs. Remember, this is private sector jobs. Kind of an early look into non-farm payroll. We'll see what the instant reaction is. I don't have very much dollar exposure going into today. How about you guys?
Nope.
Up to the eyeballs.
Yeah, today's such a big day. It's a huge day. We should get that QRA allotment here shortly. We've got Canadian GDP. We've got employment cost index. Then obviously the Fed in a few hours. So just big
107.
Well, a little bit of a miss here. Dollar is coming under a little bit of pressure. You got the sterling back at 127. Euro's pushing back up towards 108.50, which, you know, I'm like, man, give me 109 today. I'm hoping that we get 109 ahead of the Fed. This is how I'm actually trading the euro, just so you guys all know. And this is going to be a freebie for all of our listeners in here that are not in the ForexAnalytix chat room. I'm looking for a move up to 109. If I can get that ahead of the Fed, I'm going to play that. And the reason why I'm going to do that is because I think the Fed is going to be a little bit more hawkish today. You're going to see a little bit more pushback from the Fed. You know, it's interesting. I've been reading a lot of analysts, and so many analysts believe the Fed is in the right to lower rates in March. Now. Well, not now, but well, I mean, you probably get a few of those, but most believe that March is the time where the Fed can start lowering rates. I gotta ask you, Ryan, do you think the Fed will lower rates in March? I know the market's pricing.
Not in a million years. Not in a million years. Not in a million years.
Yeah, I don't think so either. Now, what is your reasoning why that I don't believe it, because I don't believe they're done yet with inflation and financial conditions are way too loose right now with stocks at all-time highs. I mean, that's just my very simple like explanation. What do you say?
Yeah, the data just doesn't warrant it. It's just not warranted at the moment, and it's the same for all central banks. You compare US to Europe, growth is, you know, running still pretty well. Jobs are still running well. Consumers still spending. There's no wobbles in the housing market. There's no real wobbles in financing. Yeah, we're starting to see some headlines, more and more headlines in the market, picking up on more headlines of job losses. I was mentioning PayPal, the next one, 2,500 jobs to go. So there are warning signs, but those signs.
PayPal's a crap company, though.
It's the numbers. The numbers. I mean, you know, Zero Hedge did a tweet of all the companies over recent months who have cut jobs. This percent, that percent, the other percent. They didn't say the numbers. You know, cutting 5% at 6% at BlackRock is 600 jobs. That's not going to collapse the jobs market. It's all part of soft landing stuff that goes on. You know, a few belts being tightened, cutting the costs a bit. Look at all the forward guidance. Forward guidance from a lot of firms is, you know, we're going to have a poor first quarter, or 2024 is going to be a bit soft. All these job cuts coming. There's a bit of belt tightening going on, and that's going to lead to potentially some weaker economics, but it's still soft landing stuff. You know, things don't go
and
up and down.
You point that out, and this is interesting because you talk about jobs. Like, for example, I've heard an estimate just yesterday or 2 days ago, like tech sectors like shed 25,000 jobs, right? And that's I could see that being a realistic estimate. But those are white collar jobs. Those are good paying jobs. But the jobs market is aplenty. And this is where you get a lot of people, and I'm just going to use a very, I'm not saying this is everybody in the tech sector, but you got people in the tech sector are like, oh, I lost my job. I'm an engineer. I was a junior engineer making, you know, $120,000 a year, you know, remotely, you know, whatever. Lost that job. It was a great gig while I had it. So I picked up a couple jobs doing, you know, odds and end things, you know.
And I'm going to learn how to trade.
And then they join the trader funding program, you know, whatever, you know, but the fact of the matter is,
collars?
The fact of the matter is that their jobs are plenty, not the great jobs, but jobs are plenty. And this has been a kind of a theme even where I live. I actually know a lady that's one of my wife's best friends. She's losing her job at Gore-Tex. You know Gore-Tex, that they're like technology, but even though they do like weather technology type of stuff for like governments and blah blah blah. She's been in that was a company that they'd never fire anybody, and they're you know, she's getting her, you know.
There's still a skill shortage. You know, you read the ISM numbers that we get this week and next week. You read the comments. I bet plenty of them are still talking about skill shortages. There's still enough workers, enough jobs, but there's a lack of skills, and that's what's important. So yeah, nothing is collapsing even despite the bad news. But back to the original point, I see nothing in why the Fed should start running to rate cuts in March and then going on a big cut spree.
Yeah,
not
and but I'm gonna have to. I want to say this though, really quick. When or if, you know, and some of you will say, well, it's just a matter of time. If we get to a point where you start to see job losses, and this is the point I've made over the last couple months, the job losses are going to be fast and furious, because if we truly do end up, you know, losing jobs, and we start to see the, you know, non-farm payrolls, you know, losing a couple 100,000 jobs a month, it'd be because there are a lot of lower paying jobs that will be cut really quickly if the sentiment really turns in the jobs market. I do believe that it'll be fast and furious. It's not going to be a slow bleed. It's going to be a like, holy shit, you're going to see spikes pretty aggressively. But anyway, but we're not there yet, as you're pointing out, Ryan. We're not there, and that's the fact. And that's why I believe that if you do, you know, if we do see some dollar weakness going into the Fed, I actually want to be on the short side of the euro. I want to be buying dollars, and that's what also alarms me about the dollar yen. So, I want to probe Kman here as far as the dollar yen goes. Look, this thing has not pulled back. I want to just give everybody a little context here with the dollar yen. The pullbacks have been to a 24% retracement. That's a shallow retracement. And if you want to be even a little bit more, technical with me, we've got a nice little pennant developing on a very shallow retracement. The dollar yen looks like it could get violent to the upside if we get some dollar strength today. What are your thoughts about the dollar yen, Kman?
I have said as much on the Flow show this morning. It's a dangerous trade right now. And I've shown the yen crosses, and quite a few of them could be in bullish flags, and or at least consolidations after.
Yeah, look,
going
wow.
up. No, it's all over the place. The thing is, though, we have to be a bit careful, especially today, and that I was saying as well. If we get an overlay of yesterday, and that was kind of my idea for the month end, we should see a weaker yen come 4 p.m. London time, so in about 3.5 hours, 2.5 hours, sorry. So gotta watch those that fixing today as well, because it's logic that the yen would be sold on the fix. Yesterday it was pretty obvious that that was what the market was doing. So and then we will see, but it's still a dangerous trade, as a lot of levels are reached, or trying to suck people in, and then it reverses straight away. And
I played the yen long via Aussie yen and dollar yen. I was short right through here. I mean, I ended up losing just 20 or 30 pips on like the dollar yen and the Aussie yen, just holding them for a few days. But man, the carry costs are so high that it just, I was like, I can't sit here and sustain, long yen trades for too long. Not when there's no impetus to be long yen at the moment. And, one of the things that scares me too, and I want to talk about this, Dale, because you mentioned it earlier. If you go to just our free blog, yesterday I blogged about, the dollar, the 10-year, right? 10 years at a very big level. We're at flag resistance right now. Actually, intraday, we are there at this moment, ahead of all of this that's happening right now. And if you look at the 10-year, it does look, we're in a bull flag pattern, and it could break out to the upside. If it breaks out to the upside, that would mean, dollar
lower
weakness. Yeah, we got the bond market, resuming its short covering rally, if you will. But the flip side is it doesn't mean it needs to break out. We could actually reverse here and see some bond market weakness, and the dollar in that respect would, reverse, and we'd see a really big dollar bullish move. And following the Fed, that's not, like I said, if the Fed comes in just a little bit of pushback from the chair, and we walk away today thinking, okay, the Fed was a little bit more hawkish, you're going to see yields rip, the bonds are going to implode, and then you're going to see the dollar yen rally towards 150. And then on top of it, you just kind of throw this out there. Yes, we have a little head and shoulder pattern in the Nikkei, but just because it's a setup doesn't mean it's gonna go. A setup could turn right into a bullish continuation, which, as you know, we're in breakout territory in the Nikkei. So there are a lot of moving parts here and a lot of setups, but don't get attached. I'd wait for the, I'm going into today's Fed pretty empty as far as my dollars go, because there's a lot of times where I'm preemptive and I'll trade based on how I feel that I think the outcome's going to be today. But I think there's so many moving parts. Speaking of which, we have Canadian GDP in just a few minutes. I think that QRA announcement might come out here in the next 10 or 15 minutes. Ryan, you have any thoughts about the Canadian? I know Kman was talking about it earlier. It did bounce off of 134. Do you have any feelers on Canadian GDP this morning?
No, it's for way back in November, so it's a bit lagging. Expected up 0.1 on the month. We're still talking bumping along the floor on it. I don't think if it's a big variation, then trade the edges. If it's really strong, we can't break through 134. Then there's plenty of levels, 133.5 underneath, even down to 133. Might be worth a bit of a pick up for a fade, because we know that data moves markets at the moment, and then it reverts back to the mean or the middle of the range not long after. But swing
I don't think it's going to be huge in focus today. No, I don't think so. No. We got too much other stuff happening.
One thing I wanted to add with the Fed and to do with jobs just quickly is just be careful if he utters any lines about potential weakness in the jobs market. He could be indicating that Friday's NFP could be a wobbly one. And the reason I say that is because we had some bad weather over the reporting period. We've seen that in prior years when we've had surprise downside numbers when there's been bad weather and people can't file and all that sort of stuff.
Oh, okay. All right. Good point.
Nice, Ryan.
Hey, Kman, you talked a little bit about the EURCAD. I like this down here, and I want to show everybody this. We've been talking a lot about the EURCAD in our chat rooms. If you're not in the ForexAnalytix chat room, that this is a lot of the conversation. It's been around the Canadian pairs and whatnot. So make sure you jump in there and jump in the conversation. But I want to show everybody this 161% extension of the last bounce. 618 retracement of this entire move, and this is when you're talking about an entire move, this is all of 2000 end of 2023's range. Big move here. If we do get some Canadian weakness, we could see a little bit of Euro Canadian like double bottom action, right? I mean, and is there some Euro demand in the fixing? Is that what you're seeing right now, Kay?
Yeah, that's what the models were saying as well. So there's a bit of that going on too.
Yeah. All right.
I want to see how this EURCAD reacts once the fixings are all done, and oil is coming back from the highs, so that may be a bit supportive around that 145 as well. But I don't know. I've got a bit of a different feeling.
All right, and just a lot of support bounced off there, a little double bottom setting up, just something just in case you guys are looking for non-US dollars to trade. Let's go ahead and go over to the, I'm going to go back over to the Canadian, and let me I'm going to pull up the dollar CAD, and let's get Canadian GDP. We have ECI coming out too.
Yeah, keep an eye on that ECI.
Let me see, there it is. Let me pull that over to the side, and let me pull up the dollar CAD, and let's see if we get that Canadian GDP, and then we'll get some flavor on the ECI too. I don't see it on here, but that's all right. I've got it on another screen. We got about 20 seconds. And I just want to say, guys, gals, be really, really careful around the FOMC today. A lot of moving parts. Press conference is definitely going to matter. His tone has been different from the statement, and we've seen that in recent meetings. So just if you get if you get into a trade, sorry, I'm just looking at the Canadian GDP. All right, should be a little stronger.
Slightly soft.
And look at that. Look at the dollar cat, or actually, the dollar's just come under some pressure too.
Sorry, that was the ECI.
ECI is weak.
Is softer.
Yeah, 0.9 versus 1% expected. Canadian GDP a little strong. So we're going to see some dollar weakness going into the data or into the FOMC, which is fine. I think that I'm like, bring it. You know, if
I'd like to see 102.30 about in the Dixie, and I'm a buyer if that happens in the next several days.
Really, I don't know. That'd be a failure. That'd be that would scare the crap out of me. If I was long dollars and we were trading down here, I don't know if I'd want to be long, but you know, that's just because it would be a failed pattern. And then you got to look at the bond market and see what the bond market's doing, because in that instance, Dale, that means more than likely this 10-year is ripping. And if the 10-year is ripping, and here, let me readjust this. If the 10-year is ripping and we have a bull flag pattern going, that bond market squeeze is going to get gnarly, because there's a lot of bond market shorts out there. You know, positioning is, you know, being short bonds. I mean, that's been the overarching trend for quite some time. So if we start to squeeze here and yields come under pressure, that means the dollar is probably going to buckle too. So I don't know. That would scare me. But
real good seasonals in Fed.
That's what makes the market, right? This is what makes the market. So you guys, gals, make sure you check out ForexAnalytix. Be in the chat room with us. It's $1 for 10 days. Just jump in so you can have the next 10 days. Be around in our chat rooms around the FOMC. We'll see you all there. And you got one of my favorite technicians on today, Katie Stockton. So Dale, thanks for bringing on Katie. Thanks for guiding us today. And everybody, good luck with the FOMC.
Thanks, team. Hi,
Cheers,
Katie.
guys.
Hi, Katie. Welcome back. Where is she? Katie?
I don't see her. Oh,
she disappeared.
Yeah, she was there.
There she is again.
There she is. Okay.
Hi, Katie.
Hi, folks. Good morning. Sorry about that.
That's
Technical
okay.
Over here.
All right. That's okay. Welcome back.
Thank you. Yeah, good to be back.
Happy New Year to you. And, you know, I follow you, Katie. And one of my first questions would be, you said, I'm not sure if it was CNBC, that should the S&Ps clear 4,800, that it could go to 61. So I was thinking about that, and I'm going to wonder, I know Katie's a technical person, and perhaps what she's looking at is that 4,800 was the prior high, and the correction went to 4.5, and we stalled at 48 for a little while, so 48 is a breakout. You just tack on that 1,300 point range in the S&P, and you have 61. Did I guess right?
Yeah, so essentially it was the final high, so it was roughly 48.19.
You're right.
And the confirmed breakout for us requires a couple of weekly closes above. So we got that, of course, and the bigger breakout really was in Q4, and that was above about 4,600. That was a key level in our work, and a measured move objective from that breakout gets the S&P 500 to about 5220, which of course seems fairly realistic at current levels. So that's sort of
back then. Yeah.
Yeah, it's I know that's a good point.
I think I heard you say, I wish it would slow down the advance, right? It was,
that sounds like something I would say. You know, a steeper rally is harder to sustain, of course, but what we actually saw in the start of the year was, you know, a good consolidation phase. So that kind of normalized the slope of the trend to some degree. Yes. And we welcome that consolidation. We think we're in store for a few days of consolidation in here near current levels as the mega cap earnings are digested. But then, you know, when we hearken back to past advances from sort of recoveries from bear market cycles, you'll notice that the breadth surges that tend to sort of precede the big, you know, sort of bull market moves very similar to what we saw in Q4, it takes a long time to get a significant correction. So we're of this camp that, not only do our indicators not support a significant pullback at this time, if you go back to refer to sort of previous environments that could be comps, referencing the past bear market cycles,
Yes.
it tells us that we really want to stay on the right side of the momentum. And I know that's sometimes difficult from a fundamental perspective, but we feel it's important to stick with those momentum gauges. And as you could imagine, that they are pointing higher still across timeframes. So dailies, weeklies, monthlies, referencing the MACDs, they all still are pointing higher.
They're on go.
I mean, we'll have
go green. So
yeah,
will
yeah.
the difference be sector leadership during this? Looks like to me, if you're correct, kind of like a final stage melt up parabolic move to. I know some people are talking 7,000.
Mm-hmm. And so the 6,100 level, I don't think it's necessarily realistic for this year, because it just, in percentage terms, it's pretty aggressive. The way we're deriving that objective is from a measured move, going back to, if I can share my screen, do you mind?
Yeah, sure. Been waiting.
Okay, so we're looking at a measured move. I'll show you on the monthly bar chart of it's actually a cloud chart of the S&P 500. You'll see where that 6120 is coming from. And it's essentially taking this COVID corrective low, taking that uptrend, which of course was unusually strong, and projecting it higher from the low point of the bear market cycle. So that's where that 6120 comes from. Yeah.
Okay, so equality with that. All right. So
yeah, and
then do we have to respect if there are closes back under 4,800 that there's, if it is a breakout?
No, not in my work. Yeah, I mean, it's already confirmed in my work. So as long as you get those 2 weekly closes, where you get non-confirmation is when you have, sort of that 1 week above, and then it kind of finishes right back below. An example of that today would be Google or Alphabet responding negatively to earnings. That stock had come right above final resistance around 151. And looks like it'll come right back below the following week. So that would be a so-called unconfirmed breakout. And usually those are setbacks. We also saw one from gold. Gold, as I'm sure you're tracking, it had come right up against final resistance. We're calling it about 2063 for the gold, generic gold futures, and spent another week above, but then couldn't confirm that breakout. And it's proven to be a very big hurdle for the price of gold. So we think that's a setback for gold, but the longer term gauges, which hopefully we'll pull up here momentarily, do point higher and suggest that there's a potential for a breakout from that big range in the price of gold. So
how about the weakness in the miners compared to what's happening in the physical gold market and silver market? You have a comment on that?
I think that's, it's got a little bit of a double whammy, right? You have consolidation that's unfolded in the price of gold itself, but then also you have, these areas of the market like gold miners being treated as sort of more defensive areas of the market. Anything commodity related, including most of energy in the equity market, has really underperformed. And, that's in a very strong tape that has favored other sectors that are more often sources of upside leadership during bull markets. So technology, financials have kicked in. So our ETF, the Fairlead Tactical Sector ETF, or TAC, TACK, has added financials and industrials. And we expect to add another sector this week. So we're moving risk on, and what's happening there is the breadth expansion is moving from those kind of mega cap heavy sectors to other sectors like financials. So, and financials is a big one. I mean, that's a big piece of the S&P 500 in terms of its weighting. So that's something that we think can contribute to this strength here, or the longevity of this bull market cycle. And then we also highlighted today in our weekly report that the stock 600, a European benchmark similar to the S&P 500, has a confirmed breakout, and that shows just the broad participation, even from areas of the market that have underperformed. I mean, European underperformance has been real, but there's some signs of downside exhaustion there that shows us we could get some stabilization in relative terms from European equities for what it's worth. So we're really seeing that.
Could that be because they're that the dollar after this bounce is complete could head lower, and that's going to favor emerging markets, take the pressure off them, and markets outside the U.S. that have been underperforming with a strong dollar, you'll get better performance overseas?
I think it would make sense that, you know, it's not a sort of a one-for-one correlation that we have there. But generally, at least especially for emerging markets, you do see that in the relative performance, right, where it certainly improves with a weaker dollar. Here's our dollar index chart. You can see, you know, it's come into the cloud. This is the daily. It's come into the cloud.
Where's the upper end of the cloud, Katie?
The upper end, if we look out to next week, it's at 103.86. And so not terribly far from these recent highs in here. But I appreciated Blake's, you know, sort of mention to say, you know, it's good. There's a lot of risk in here with the Fed announcement, and I would add to that the mega cap earnings more broadly. So I don't know that there's a trade here at this moment, but there is resistance at the cloud. And if you see here, look at the MACD histogram. That histogram there has been trending lower for some time. So it suggests that it's sort of on the verge of this daily MACD sell signal, and you have a short-term overbought downturn. So collectively, the metrics do support a lower dollar here. I can't say I have any edge ahead of today's announcement.
I'm looking for 104.80, 105 as a sell zone for me.
Okay. So then, you know, there's no DeMark signals or anything to speak of. So I don't have any indication that will go higher, but I also, you know, think that, you know, it's really difficult to put on short-term trades ahead of these types of events. So we generally stay away from them. You know, if you follow our work, you'll notice that we won't really comment on a stock that has earnings within the next day or two, unless it's just to provide levels and information, because, you know, it's hard to have an edge when there's, you know, a sort of a headline risk there.
Where are you at on Apple and its underperformance for quite some time now? And,
it has underperformed. I think importantly, the rest of the mega caps have done very well. So as much as Apple is important, it's a bit of an outlier in terms of its relative performance. And it has maintained its uptrend. You can see it here. But notice that this is on the monthly chart. Notice that the MACD is sort of neutralized. And that just feels like it's a function of a DeMark signal. You had a DeMark sell signal back here, seemingly, you know, suggesting it was overdone. But I wouldn't rule out a breakout ultimately for Apple if it can get through that 198 area as a positive catalyst. That would be certainly, I think, actionable. Right now that there's a little room to support, which is roughly 183 on our chart based on the daily cloud model and also the 200-day moving average. So if I was looking to add to Apple, I'd probably wait a little bit, but not a long time, because I do think that we'll see that long-term momentum pick up again. You know, but
gotta
as
hold
you
180, Katie. Underneath it, there's a lot.
I think 180. Yeah, I agree. 180 is kind of a key level for it, and
or it'll become another Tesla.
Oh goodness, I know. Well, here's the good thing about Tesla is that, and listen, this is a good short-term thing, but whenever you see an earnings-driven gap down, or just any kind of big gap down like that, when you see that the security come back up into the gap within the next, I'd say, like, you know, week or so, like you saw here, you see how it got inched right up into the gap yesterday. That usually means that gap will be closed pretty quickly. So for those that are stuck holding Tesla, I would say just give it a little time and room, and you might be able to pare back closer to former support, which was roughly 208 in our work. It is a meaningful breakdown, though, if it hangs down here, because this is the monthly. You see how it's below the cloud. So if it hangs down here, you know, reacting to this weakening of the long-term metrics, well, then that becomes, certainly a selling opportunity into the bounce.
How about the downgrade on Intel, which really did participate for, you know, not kind of a new age AI stock, and really got cratered on that downgrade. And I wanted to
Yeah.
ask you, but you were probably too young. What were you, about 5 years old in 2000?
Oh, that's kind of you.
Were you in kindergarten? Because when we had the downgrade in 2000, Bill Henner, a floor trader, guest of mine, sent me a message on Friday saying that he was having a flashback that back in 2000, after the downgrade in Intel, it marked a pretty important high, and that was the
Yeah,
.com area.
it did, but you know, we have to have the market context, right?
Yeah.
So and such an acceleration. So this is an acceleration that had followed an already sort of prolonged bull market cycle for not just Intel, but the broader market. This is different because it's effectively a turnaround after a bear market cycle. So I would, as steep as that is, it's a much different composure. And what I'm encouraged by is the fact that on the DeMark work, not only did it respond to this DeMark signal down here, this is this 9 is a so-called sort of oversold buy signal, and here are the sell signals here on the 13s. This 9 here, it kind of just shrugged right off, and usually when we see that, you know, it tends to be a very strong market. It's a loss of momentum for sure within this turnaround. This is on the weekly Intel chart. I think it's just a correction. I think it'll ultimately give way to another opportunity to take advantage of this turnaround, this longer term turnaround. There is good support, and it's roughly like 40 to sort of 42. There's definitely some support in there.
Okay. I know your view for bonds, 10-year yields are about 330 sometime this year. Can you show us technically how you get to that level? Because I was thinking maybe one more bounce to 440, and then
yeah, you know, it's funny that 440 level is a level that we're watching too, and I wouldn't rule that out with obviously the possibility for macro news, right? But here's what we're seeing. Our indicators don't point to it right now. So if we look at the daily chart, which is what we posted in our weekly report here today, here's your relief rally in yields. Came into the not just the 50-day, which is certainly a point of reference, but the cloud is our kind of key resistance area, right? So the cloud has provided resistance, and then we have these downturns in our short-term metrics. If today's action or non-action leads to it to come into the cloud, so let's see what that would be, above 410. If it gets above 410 today, well, then I think 440 is actually pretty realistic. That's right at the upper boundary. See that at the cloud? So today does have some significance in terms of the short-term implications.
And then if we got up there, Katie, equality of the first break, which was 120 bips, from 440 gets you 320.
Yeah, and here's like the really important takeaway is that this corrective phase or downdraft that we've seen off of 5%, look at what it did. This is on the monthly chart. Look at what it did to the monthly stochastics and this monthly MACD. Even more importantly, that MACD had been supportive of the uptrend since late 2020. So it tells us that the significant loss of long-term upside momentum could give way to, I don't know, a year, 2-year type of corrective phase. So, and that's not unusual. I mean, we saw during the downtrend.
Cloud is under 2.
Yeah. And I think the cloud's probably not super relevant at this time just because it is so far, but also, we're advancing from a range. This is what we're watching is sort of this as our cyclical up move. And now we're in this corrective mode. So about 3.25, so 322, and then these lows around 3.25. That to us is the kind of key long-term support level. In the interim, there is a cloud-based support level that kicks in around 390 for the weekly cloud. So maybe it stabilizes in there temporarily, but we do think it's a corrective year. And that's something that certainly could provide a tailwind for equities and some other asset classes.
Yeah, so TLT had a very nice move from what was 82 to 100.
Yeah, and I do think that's meaningful. Just to the same point really. And we had we highlighted in TLT We have sort of in the tech ETF an equivalent of TLT, which is SPTL. And, you know, we saw this 13, which is a DeMark signal. It was the first counter trend signal since this on the sell side. So that had us paying attention and look at the subsequent upturns in our long-term metrics. So we think this is an important low. Again, it could be an important low, maybe with 9 to 12 months of duration, not 3 to 5 years. But it does suggest that the bear market cycle from here, it has ended or matured into something that at least looks more like a trading range. If not a reversal that's a little bit more pronounced than that. So that suggests that we kind of maintain treasury exposure, but we would look for equities to outperform in this environment. So we would still have some exposure, but we would look for outperformance from the S&P.
You've held core positions in energy stocks for a while, and I'm gathering with it being a laggard in the last 6 months. Do you still hold your core energy position?
No, you know, we kicked it out a while ago, actually, and it was really, you can see why. It's just the loss of long-term momentum and also relative strength. So we look at these, we look at them from a long-term perspective. So for one, if you look at XLE, this is the energy select sector spider. It's got a lot like a triple whammy in a way of negative indications. You had a DeMark sell signal, you had a downturn and a negative divergence here, and of course, very weak long-term momentum. And then we have in relative terms, we track the ratios, and you can see a pretty decisive downtrend having unfolded. This is sort of where it peaked was in early 2023. We had a good relief rally, but it's clearly entered a downtrend cycle. You can see that in the 200-day moving average. So yeah, we're out of energy.
Opposite scenario in uranium, Katie. With
uranium, I laugh because this was one CNBC pushed us for an idea at a time when the market was just lousy, and I used uranium because, I mean, there's always an uptrend out there somewhere, right?
Yeah.
And it just happened to be one of the few at the time that had an uptrend in place in what was still a bear market cycle for equities. So here's uranium. Yeah, I mean, what great long-term momentum characteristics you have here. And then a relatively new breakout. And what we've been seeing is that the breakouts have been pretty actionable, certainly in the equities. But here also, we feel like once we get these breakouts that we have the rationale to add exposure into these types of pullbacks. So certainly a good setup here.
And also, you were right about the minute you guys stopped covering cannabis stocks, they would bottom and turn up.
It's funny, yeah, that you remember that.
Yeah, so it really was pretty close.
Yeah,
it was pretty close.
Isn't that just Murphy's Law, right? And you can see, I mean, there's a good basing phase in place here. So really, this is MJ, the ETF, but here's a DeMark buy signal that's still actionable. And look, the MACD just inched. This is on the weekly, just inched into positive territory for the first time.
Let me get my magnifying glass.
I know. We should be using a different scale.
All right, yeah, okay. So, I mean, there's a lot to be long.
Yeah, and that's when we do our bottom-up work and look through the components of the S&P 500 or look for ideas for our Substack newsletter. It's not hard to find really compelling setups. You know, at times we'll, want to avoid consolidation phases and let the market come to us a little bit. And yet, there's very broad participation. So I really do think that this is a stock picker's market, and meaning that fundamental analysis will pay off a bit more than it has. We obviously are technicians ourselves, and top-down influences are always super important to have a handle of. But in certain environments, like a bull market cycle where a breadth is strong, that's where you can really dig into the fundamentals and find these great opportunities. And I think the rotation into these sort of higher growth segments of the market, the cloud computing stocks and sort of small and mid cap tech, that there's some really major base breakouts in that segment of the market. And I think that that's something that we, should be paying attention to. So to the extent that these companies have, sort of fundamental prospects, right? Look at these. I mean, this is just Snowflake as one example.
The longer the base, the bigger the launch into space.
Yep, that's right. That's right. So here's, look at these base breakouts. These are really, they're very widespread. There's something that can obviously contribute to the longevity of the broader bull market cycle, but these could be, 3-year type, advances in the making based on the width of the basing phases. So we're certainly encouraged by the action in high growth names.
Well, they're probably even going to, I mean, there's so much constructive stock action that the micro caps, which I don't care what sector they were in, all got killed.
Yeah, I mean, wow, that you're right.
They could really come back, couldn't they?
Yeah, and we saw it, and especially from last year, that tax loss harvesting season was really brutal on the small cap complex.
Yeah.
But it was followed by like a pretty violent relief rally, and that relief rally off the October low, this is just IWM, but it lifted a lot of the small cap benchmarks and even equal weighted benchmarks in turn above key resistance levels. So we feel like this range for IWM is resolving to the upside.
Okay.
And these are pretty widespread setups, and see like this even is a very bullish sort of short-term indication. We call it a stochastic pop. So we're pretty constructive on small caps as a function of the breadth behind the market. It's still a bit early to say, okay, well, we're going to have lasting outperformance here, but you can certainly make a case for relative stabilization, meaning that small caps at least perform closer to in line with the large cap complex.
Okay. Katie, every time you come in here, my mind is open to a different view than I had before we started talking. And
that's great, Dale. Really good to hear that.
Really, I say to people, keep an open mind. It will keep your account open. Right? So
good way to frame it.
Yeah, and I want to thank you. We've been talking for years now. I want to thank you for coming to edify our community with your great technical work every 3-4 months, and really hope this is one of your best years ever.
Of course, Dale, and I really appreciate that, and always glad to join you all. And by all means, stay in touch.
Okay, so follow Katie on X at Stockton Katie. You want to show your website, Katie?
Oh yeah,
where
I can do that.
Maybe you have some new stuff going on for this year where retailers could come and edify themselves, learn.
We do have. So what I will say is that the best way to get to know our methodology, we're very oriented to sort of systematic research. We have actually 9 reports that we're publishing a week, so we're very prolifik. Almost sometimes I say, why do we have so much?
To say.
fairleadstrategies.com. What I would encourage folks to do is just to go to request a trial, and you'll be able to see the full suite of research. And I think the value in it is just the consistent sort of episodic coverage, and in the same way, Dale, that we're talking today about the markets.
Yes.
We're not ultra predictive in our work. We're just trying to help folks manage risk and stay on the right side of the tape, and at the same time generating a lot of ideas. And then we also have a relatively new newsletter called Idea Generator. This is on Substack, and this is just my dashboard. But we put all sorts of ideas here, just actionable setups from a bottom-up perspective. So for those out there that are trading individual stocks, this might be of interest, and it's very inexpensive. I think it's $9 a month or something close to it.
Well, I strongly advise people to include Katie in their intelligence gathering. If you don't, it's not intelligent. So really appreciate your work, and you, Katie, and everything you do. Thanks again, and I'll get in touch with you and talk in the spring.
Same here. Take care.
All right. Katie Stockton, everyone. I know you enjoyed it. It's always fun for me, and She sure makes it hard to be a bears. So that's a wrap for us here today. Katie, everyone really appreciated it. And remember, don't just count your pips, count your blessings. Good luck on Fed Day, everyone. And I'll see you tomorrow. Adios.